Morning, ladies and gentlemen. Welcome back to Morning Kappa at 8. I'm Joseph here. So looking at the last week market, right? On the Friday, Hong Kong market closed for trading, but it's going to resume today on Monday, right? Looking at the last Thursday price actions, Hang Seng continue to face a mild selling pressure. It showing continue to shows that the technical setup remains bearish so far. There's likelihood that Hang Seng will correct towards 23,500 point level. So at this juncture, we'll keep our stop loss point unchanged at 26,000 point and we'll stick to on the bearish bias. Now, on a week-on-week basis, right, two sectors or two counters is actually supporting the Hang Seng Index. Firstly, 981 SMIC that rebounded by 6%, moving sideways right now. Then on, we also have the HSBC, which is the banks that everyone knows, number five, right? It rebounded by 10%. Right now it's trading at a historical high right now. So these two counter has been supporting the Hang Seng Index. Meanwhile, CATL also staged a rebound after a slew of corrections, rebounded by 8% last week, right? And looking at the China A50, right, the sentiment remains calmer if compared with the Hang Seng Index. Now, China A50 is tracking the 50 largest stocks in China, and right now, the past 2 weeks, it did experience a mild selling pressure, but it managed to bounce above 15,300 point. So going forward, this 15,300 and 16,000, this band will be a consolidation band for the China A50. Right. So if you're bullish on this index, you can look at the big cap stocks that track under by the China A50, which is the most one of the most liquid futures product in XGX. And we also see that in the this heat map, right, on tracking all the Chinese stocks, we can see that the um, share price performance on a weekly basis remains positive on the A shares, right? And we can see that the a few Shanghai as well as Shenzhen shares have rebounded in the range of 3% to 7% week on week. And just to catch up. Recap on one of the counters that I've shared with you 2 weeks ago. This Guangdong Fenghua, right? Stock code 000636. You can see that the share has been moving up steadily after breaking past 62.50 resistance. Right now, it's testing the 75. Breakout on 75 continue to move towards 80 and followed by 85 renminbi, right? So this is one of the bullish stock in the A shares market. I think if you look at the China market as a whole, right, you can see quite easily to find bullish stocks in the China A shares, be it in the Shanghai exchange or the Shenzhen exchange, right? And so last week after the Fed meeting, market is discussing or what's the year-end interest rate will be, and we can see that right now, market is trying to look at one rate hike for the next July meeting, right? And about 37% think that there will be at least two rate hike this year, right? So in totality, about 32% think that there will be one rate hike, and then more 37% of the traders think that there will be a two rate hike in this year. Now, despite that the market is having think that the market is going for rate hike, right? S&P 500 continue to move higher. Last week it managed to climb above the 7,005, right? Despite that the oil price is actually moving downwards. So I think over the last week, all the attentions is between US and Iran. And what we do know is that the negotiation is still ongoing. But as a latest development, Strait of Hormuz has been closed again. But there was a few days, I think on the Tuesday, Wednesday, and Thursday, the straits was open. And according to the Kepler, one of the market intelligence that track the LNG, those tankers around the world, I have mentioned that at least they have seen about at least 20 ships have been leaving the straits on the Thursday. So at this juncture, on Friday, Now, what we have learned from the news is that the strait has been closed. But I think more important is that um, the US have resumed the peace negotiations with the Iran in Switzerland, and the negotiations is being chaired by the JD Vance, the vice president, as well as Kushner and the right as well, the special convoy rep by Donald Trump. So we shall see after the market open today what happened on the oil price. But at this juncture, we are seeing that the bearish setup remains intact. We set our stop loss at 100 US dollar. Meanwhile, on the oil price, right, the oil have dipped lower this morning. It have went to 4,001, and as we can see that market is looking for higher interest rate this year, and funds are actually moving out from gold towards the bond market, and can see that selling pressure is strong on the Thursday and Friday sessions after the Fed meeting, right? And as for the US market, sentiment on the equities market remains strong. Just over the week, you can see that Micron have went up by 25%, as NDK rebounded by 30%, and Intel 18%, AMD 16%. So the taste market have a very strong taste on the memory counters as well as the chip counters. Okay, and as for the trading stocks, I do see opportunity on Intel. They have managed to break above 130 US dollar. So next hour will be 145 and followed by 160 US dollar. Down support is 115. Now then on secondly, we have Corning Incorporated, this US company that they have managed to secure a multi-billion deal from the Amazon AI, right? The share price have break above 190 US dollar on the back of high volume on Friday. So should the momentum continue, Corning stock code GLW be testing a 210 and followed by 230. Downside support is 175. Now, meanwhile, Malaysia have experienced a very strong buying momentum last week. The FBM KLCI eyeing to climb above this 20-week SMA line. Now, in the past, we can see that whenever the FBM KLCI climb above the 20-week, the markets will be bullish thereafter. So whether this week the momentum will follow through, that's what we are going to see. So if the momentum follow through, likelihood the FPM KLCI will climbs towards 1750 and followed by 1008. So on the downside, major support remain at 1645. Now this chart is a weekly chart that we look at the higher time frame chart. So last week, the flows are going into technology, constructions, and consumer. Meanwhile, energy, industrial, and healthcare experienced profit taking last week. So we continue to stay on bullish bias FKRI despite that FKRI moved sideways last week. So our stop loss is at 1650. Then on FCPO have a very strong price actions on the Friday. It has been moving up for the third consecutive days, eyeing to break past 4,007. So still keep a bearish bias until the FCPO closes above the 4,007. So meanwhile, looking at the Malaysia market, so you can see that last week Asia X have a very strong flow. It went up by 13%. So market is looking at the escalations on the US and Iran, and hopefully the oil price are moving lower. That will be positive for the airline and also the travel counters. Meanwhile, market continue to move into the tech stocks. You can see that UWC went up by 17%, and DNEX have a very strong upside movement last week by 34%, right? And this morning, I do see opportunity on ECA integrated that the share price have a break above 24 cents resistance. Next R1 is 27 cents half and followed by 30 cents. Downside support is 22 cents. Now, apart from ECA under the tech sector, we do see that Skychip also have a very strong momentum on the Friday sessions that climb above 3 ringgit resistance. The next R1 will be at 3 ringgit 20 cents and followed by 3 ringgit and 40 cents. So the downside support for Sky Chip will be at 2 ringgit and 85 cents. So this morning we have two breakout stock, ECA and followed by Sky Chip. So I stop here and pass on to Sian on the weekly Rasa Mingguan report. Thank you.
Thanks, Joseph. So good morning, everyone. Please let me to share my screen. I hope you can see my screen now. So over the last Friday, at least as per last Friday, we do see that our RHB sentiment index has recovered further towards risk on. So with US equity futures also rising sharply as risk premium actually narrows. So our RHB sentiment index has improved over the past 2 weeks, reflecting easing geopolitical premium, at least until last Friday. So assuming a US-Iran ceasefire evolve in a more durable peace agreement, so we do advocate a shift in asset allocation toward overweight US and ASEAN equities, market weight on fixed income and underweight position in cash. However, the geopolitical condition for now is still remain uncertain yet, as the talks scheduled between US and also Iran over a peace deal we actually clouded by a renewed threat from President Donald Trump to actually strike Iran again. So due to the announcement of closure of Straits of Hormuz over the last weekend. So as what we see in last Friday, Brent declined sharply to $77 per barrel, but still around 28% higher on year basis. MSCI will move higher, but the investment grade bonds is actually flat. So following the statement by President Trump, so the oil price to actually increase to over $80 per barrel again as per this morning. So moving on into the global CPI heat map, actually Kevin Walsh hawkish rhetoric is not surprising at all, where the US CPI actually rose by 4.2% in May, which is the highest since April 2023, where back then it's actually at 4.9%. So for ASEAN, so we do think that the softer oil prices towards $77 per barrel and now over $80 again may not help the year-on-year inflation, at least in the near term. So we do watch out for elevated inflation into second half as well. So we will see that there's some upside pressures in the inflation for selected ASEAN economies as of now. So and then recent market pricing in rates appear overly reactive to actually fact check Kevin Walsh hawkish remarks as well. So the uptick in the treasury yields seen in early Friday likely overstates the policy conditions as well, particularly against a backdrop of improving geopolitical conditions. So we do observe Walsh assertion that inflation cannot be tolerated, remain consistent with established Fed rhetoric as well. So more importantly, so our analysis, which is the RHB modified Taylor rules model, so do indicates that the US inflation momentum has actually continued to decelerate, and also Taylor rule framework does not really support additional rate hike in 2026 as well, as our model do suggest that the federal fund rate will stay pat for 2026, and we'll likely see a 25 basis point cut by 2027 as well. So, and then moving on the FOMC statement. So while the FOMC actually held steady in June, investor attention has shifted to the top cut as well, which offer limited directional clarity as of now. So the distribution, as what we see, 9 participants actually has signaled a hike. So 8 favoring no change and 1 indicating a cut. So out of 18, so with 1 actually absent. So reflects a committee effectively split between the tightening and also pause, thus also underlining little conviction regarding the trajectory of the federal fund rate in this year. However, as what we see in the Fed economic projection, they still continue to frame elevated core PC inflation as transitory. So with a return approximately 2% by 2028 as well. So moving on China. So for now, we still maintain a bearish stance on Chinese equities with recent declines led by internet and also consumer sector weakness has pushed the MSCI China down approximately 20% from its October 2025 peak, technically entering bear market territory. The sell-off has been partially driven in part by foreign investor outflows, Concurrently, the high frequency indicator actually still remains soft as both retail sales and also our fixed asset investment contracted further in May as well. So reinforcing our expectation of a sub-trend GDP growth of around 4.5% for China in this year. And then closer to home, we have the release of export and also inflation data for Malaysia as per last Friday. So for exports, so the May exports data is still remains strong. In fact, it actually accelerated by 45.3% in May. So versus a strong print of 36.9% in April as well. Also surpassing the market consensus estimate of 29% and our in-house projection of around 16%. So on the other hand, we've also seen that the imports has actually rose by 14% in May as well. So we remain optimistic on Malaysia export outlook in this year, so supported by a sustained strength in the E&E sector, as evidenced in the recent data releases. For example, in May itself, so the E&E exports actually surged by 70.5% year on year, while the refined petroleum product has also surged by 80%, with the LNG exports also soared by over 100% as well in May. So for the first 5 months of the year, the exports of Malaysia has been expanded by 24%. So despite the lingering geopolitical uncertainties, pointing to further upside to our current export growth forecast of around 15% as of now. So the export of E&E exports remain constructive, underpinned by a robust global semiconductor demand driven by advancement in AI, data center, electric vehicles, and also industrial automation as well. However, looking ahead, we're still seeing that the external outlook will remain influenced by developments in tariff policies. Although now we are seeing that the potential imposition of US tariff on Malaysia exports under the Section 301 is expected to remain manageable, and also involvement in the geopolitical conditions as well. So moving on into inflation outlook for Malaysia. So May CPI inflation actually came in at 2%, so versus higher than April print of 1.9%, but slightly lower than our in-house projection of 2.2%. So for the first 5 months of the year, so we are seeing that the inflation is at around 1.7% for the first 5 months of the year. Meanwhile, the core CPI inflation remained at 2% in May, which still signal a persistent underlying price pressure and resilient domestic demand as well. So we still maintain our 2026 headline inflation forecast in 2.1%. So inflation dynamics still warrant continued monitoring amid signs of firmer upstream cost pressure, as well as what indicated in the increase in the PPI data recently. So recent data do indicate a broad-based increase in the PPI across major sectors, so suggesting that the upstream cost pressure warrant continue monitoring as well. However, domestic policy measures and also stable demand condition also help to contain the pass-through of external cost shock to the consumer prices as well, with any impact on headline and core inflation expected to remain gradual and manageable. So looking ahead, the inflation outlook will be shaped by firstly, commodity price movement, changes in domestic policy, and also potential upsides from the food inflation as well. That's all from me. I will pass the stage to the next presenter. Thank you.
Thank you, Sian. Let me just move on to a results review on VS industry. This is a 9 months results. Basically, the results actually disappointed on weaker than expected key customer orders, as well as persistent margin pressure from low utilization rate amid the soft end market demand. If you look at 9 months, revenue actually declined 9.5% year on year to 2.65 billion. This again, with a soft demand from its key customer, as well as underutilizations, which drive the GPM margins decline to 3.2% compared to 7.9% in 9 months of 2025. Philippine operations remain the red during the ramp-up phases, recording a loss of 7 million in the second quarter. However, the group reported a net loss of about 33 million, in the third quarter itself, which again deepened by the underutilizations of its resources and also facilities. Now, the post results, we expect to FY26 to record a net loss of about 12.6 million versus our previous core net profit forecast of 26.6 million. We also slashed our FY27 and 28 earnings by 30% and 32% respectively. This is after we reduced the medium-term sales and margins assumption. This in turn, would cut our target price to 31 cents, from 45 cents previously. This is based on an unchanged 12 times FY27 P, well below its historical mean. Now, in terms of outlook, we do expect the earnings to recover gradually from fourth quarter onwards, supported by stronger seasonality as well as the ramp up of a new program from key customers. Now, the Philippines facilities should also move closer to a break-even point in FY27 as production volume increase, and also a newly awarded program at about 100 million per annum, commencing in the second half of 2026. With a major customer cost down exercise largely completed, we expect the utilization rates to improve progressively into the fourth quarter as well as FY27. That should lend supports to the earnings recovery that is expected as soon as in fourth quarter. Now, in terms of the valuations, I think they are trading at about -2 standard deviation below its 5-year mean, and also a 0.4 times price to book, which we believe is cheap, and given its swift earning recovery expected in the fourth quarter, as well as in FY27. Hence, we maintain our buy call, and we think the current price is a good entry to a strong established name EMS names like VSI. New target price of 31 cent. We still maintain our buy call. I think that's all from us today. Thank you for listening, and we should see you again tomorrow.